Hey traders, Jason here from Leavitt Brothers. Happy Wednesday. It's only been a week since my last State of the Market video, but a lot has happened in the last week, so I wanted to do an update. The indexes fell hard for a couple days. All of them took out key support levels, but then the Fed came out and essentially said they have Wall Street's back, that they would do whatever was needed to support the economic expansion that's currently going on. On this news, the market surged yesterday, and as of midday today, it's building on those gains. Okay, so emotions are running high, kind of wild in the near term, but for the rally to sustain itself, the internals need to support the gains. Okay, we can't have a case where the market moves up, but the AD line drifts down, or where the market moves up and new highs don't expand. Okay, anything can happen in the near term. Okay, that's always the case, but for something to last, there needs to be support beyond just an emotional outburst that takes place in the near term. Okay, so in this video, I'm going to run through some of the index charts and then see where the breadth indicators stand to see how much support the market may have. All right, so first up here is the S&P 500 daily chart. Looks kind of confusing because there's a couple moving averages here. I'll point out a couple. The 50's been pretty good long term. That's the blue line. The 21 EMA has been pretty good in the near term when it trends. That's the orange line here. Okay, so what happened here is the market moves up. Okay, not sustainable. Eventually breaks down, goes to the 21 right over here. Okay, not a big deal. It kind of does a little dance around the 50, breaks down, finds a support level 2800, breaks down again, and then it bounced. Okay, so a couple things to point out. I mean, it took out the 200 here and then bounced, and then it led to the rally, and it took out the 200 here, and now it's bouncing. Okay, so if you're looking for some sort of symmetry, you could be looking for a bounce. Okay, but the orange line here, which is the 21, has been a key level for a while. Okay, it's here. It runs all the way through here, so you can see it supported the market on the way up. It rejected the market on the way down. I don't think we can get overly excited about the bounce yet until we get above the 21, come back down and test it maybe, and then continue on. Okay, so the bounce is nice. It feels good. It gives the bulls a little bit of relief, but by no means are we like out in the clear and trending up. Okay, that orange line here, which is now blue because I drew over it, is a key level, and until we take that out, I don't think we can get overly excited. And then, of course, you have the 50 here, which is coming here, and it's probably going to flatten out a little bit. Okay, and we got to get above that too. Okay, so step one, nice bounce. Okay, but I don't think by any means we could actually relax and just assume that we're going to go back up at the highs. It's possible. Okay, right now I'm positioned long, but I don't think we can assume it's going to happen. All right, next chart. This is the Russell 2000 small caps. As you can see, if I go back all the way to here, basically mid-January, the Russell has spent most of its time within a range. Okay, we had a little bit of a pop over here to a new high, a little bit of a pop over, dropped here to a new low, but it has spent almost its entire time in a range. Its 50 and 200-day moving averages are in the middle of the range. I don't think you could be anything other than neutral, maybe even leaning down here. Okay, even if this kind of comes up, we have the 50 and the 200 to contend with, and that's not going to be easy on the first try. Oftentimes, when you get a bounce, it takes a couple of attempts. So I don't think there's anything to get excited about. Okay, we lost the bottom of the range. We moved back into the range. Nice first step. Okay, great. But it's got to be able to hold the bottom of the range, make progress up, and eventually it's going to have to deal with these moving averages up here. Okay, it's making progress, I guess you can say, but certainly nothing that you could get long and just hold on and just assume that, like, hey, we're going back to the highs. Next chart, here are the mid caps. Here's the S&P 500 mid cap. Okay, it looks kind of similar to the small cap. If I go back here, I can draw a fairly, I can draw a range in here. I could say the small caps or the mid caps have spent most of its time in the range, just like the small caps. We had a dip down here, but a quick recovery. I don't think you can be anything other than just neutral here. Okay, maybe we go up. Okay, maybe we go up. Maybe we can hold this level and make progress from there, but until it happens, I don't think you can be anything other than a neutral and somewhat lukewarm. And you can recognize the potential for the market to move up, but until we get more progress here, I don't think there's anything to get overly excited about. Okay, you definitely need some mental flexibility here. Okay, backing up, here's the S&P 500, the weekly chart. The 50-week MA has been really important. Okay, you can see here and here and here, and you can see along here it supported the price. Things got a little bit messy here, but we got some support here. Took out the 50 last week, recovered this week. Okay, so allowing for a little bit of wiggle room, you could say that, hey, it's holding for now. But if you back up, I mean, this isn't, allowing for a little wiggle room. The index has spent most of the last 20 months or so within a range. Okay, maybe there's a slight, if you focus on the red trend lines, maybe you can say there's a slight upward bias, but overall we're flat going back to the beginning of 2018, and we've traded in a box for about the last 20 months. Okay, so nothing to get overly excited about. The market is neutral. It's kind of lukewarm. I don't think we could have too strong of a bias here. Okay, no reason to just back up the truck and get long and assume we're going back up at the highs and well into the 3000s. Okay, it's very possible, but I don't think we can be positioned to assume that's going to happen. Okay, zooming in. Okay, that was the weekly chart. Here's the hourly chart, which is my near-term bias. Okay, the most important line in this chart is the 50-hour moving average. Okay, you can see up here, hourly chart, and the blue line here is the 50, so you can see how it supported prices here, and then we had resistance here and resistance here, some support, resistance, support. So it's been an important line in the sand for developing a near-term bias. Okay, right now we're above it. Okay, which is good, and so bias is going to be to the upside. And for the bias to stay that way, it's got this moving average has to hold. So if we get any type of dip here, it's got to hold and continue up. Okay, that's pretty clear, pretty mechanical, somewhat quant-like. Bias is basically determined in the near term by whether the S&P hourly chart is above its 50. Right now it is. So it's good, but it was also above here, and it eventually lost it. Okay, so I'd say step one, in good place, in place because we got above it, but it's got to hold. All right, now let's look at some of the breadth indicators. Okay, here's the S&P 500 versus the 10-day, the AD line and the 10-day moving average of the AD line. Okay, as you can see, AD line has been leaning down. Okay, as I've said many times, that a characteristic of a healthy uptrending market is you get steady prints mostly above zero. There are occasional dips below zero, but those dips don't last long. So it's not the case right now. We have a lot of prints below zero. The line is trending down. So going forward, if the market continues to move up, we need this to get above zero, and then we just need it to oscillate up here. Something like this. Okay, doesn't have to go really high. It's allowed to drop below zero briefly, but it has to recover. But if we can just get some prints above zero at a decent level, not too high, not too low, that would support an uptrend. Okay, we're not there yet. As you could see, we're not even above zero right now, even though we got yesterday's bounce, today's continuation. So that's what we need. We need a recovery here, and then we need steady prints above zero. It's not happening, but it's something that we need to look for going forward. Okay, here's the same chart with the NASDAQ. Okay, similar concept. Okay, we need prints above zero. We need this to recover. Whoops. Let me get rid of that. We need prints above zero, and we need them to stay. We need something like this. Okay, you can see over here where it got below zero and got trapped under zero and eventually led to that. And you see there are, this move up here was accompanied by a move up here, but then it lost it immediately. They came up here, got rejected, lost it again. Okay, so we need a move above zero and then steady prints above zero, and then the market will be fine. Absent this, the market won't be fine. Okay, here's S&P 500 versus the common stock only new highs at the NYSE and new lows. What we want here is we want steady prints at a decent level, not too high, not too low, just something steady. Yesterday we dropped below the low of the range. Not yesterday, but a couple days ago we dropped below the range. Today we've recovered. We need, going forward, we just need steady prints up here. Okay, if we get repeated prints, if we get stuff, well, I can't go below 0. So I'll delete that. So if we start getting more and more prints like down here, somewhat reminiscent of this, then I'm going to start getting worried. Okay, a dip below, fine. I'll let it do it for a day or so. Now that it's recovered, we need steady prints above, let's say 50, in order to confirm or suggest that the market has some health left. Okay, that's what I'm looking for. Okay, same chart with the NASDAQ. NASDAQ new highs have been subdued for a while. I guess we want prints up here. As long as it continues, we're fine. If we start getting prints, getting prints like down here, then there's going to be a problem. Okay, that's what we don't want. We don't want low prints that just kind of stay there. Okay, an occasional dip, fine, but we don't want steady prints down there. Okay, so right now we're okay, but if this continues, we want this to move up, and then we want it to be able to maintain the level. Okay, small chart here, S&P 500 versus the percentage of S&P stocks at a 20-day high. Okay, so what we want here, like so many other indicators, is we want a recovery and then prints up here. Okay, the dotted line here is the mean. Okay, we want steady prints above and below the mean, mostly above, but we can go below, something like that. Okay, if we get repeated trips, if we get a recovery here, but then another print down here, that's a major warning. Okay, we want a recovery and then steady prints at a high level. We don't want any dips back below, 1 standard deviation below the mean. Okay, a couple more charts here. Here's S&P 500 versus the percentage of stocks above their 20-day EMA. Okay, as you know from watching these videos, a characteristic of an uptrend is you get steady prints above 50%. A drop below 50% is a warning. Failure to recover from that is going to be a warning. So yesterday, because of the strength, we got a move above 50%. What we need here is we need a continuation, and then we need prints like this. Okay, as you can see, back in like October, November, December, you had a recovery in the market here, which was accompanied by a big surge there, but then it immediately dropped. Okay, and then you had another rally attempt, which was accompanied by this, but then you had another plunge. Okay, so what we want is we want it to get above 50%, and we want it to stay there. Okay, we don't want it to go up like this and then immediately drop. Okay, we want steady prints above 50%. We'll see what happens. We're above 50% right now. We need a continuation of that, and then we need it to hold the level. Here's S&P 500 versus percentage of stocks above their 50-day moving average. Similar in concept, we need a recovery, and then we need to hold above, in this case, 55%. As you see, this rally here moved up, but then immediately gave it back. This rally here moved up, but immediately gave it back. Okay, even if I go back to early 2018, we have that rally. So we got to move up, but it got back and gave it back. We got this rally, gave it back. This rally came up, gave it back, but then it stabilized at a decent level and then eventually got back up. So I'm looking for this to get up. Even it came back down and kind of stabilized and then got back up again, the market should be in good shape. But if this thing goes up and then immediately just gives it back, then we're going to have a repeat of this. Okay, so far this thing, it has potential, but this thing has work to do. Okay, I definitely wouldn't be backing up the truck thinking we're going to new highs here. Like, the indicators don't yet support that. Okay, so overall, I'd consider the market to be in a somewhat fragile state. It could rally here and test the highs, but it could also roll over. I don't think it's obvious, and I don't think it would be wise to have a strong opinion that you dig in and defend. The next couple of weeks will be very telling. Okay, can the indexes hold key levels? Can breadth indicators improve? I don't know. We'll see. Okay, don't guess. Don't trade off what you think will happen. Trade what is happening and maintain some level of mental flexibility. And it's okay to sit tight and do nothing and wait if you're not sure what's going on or if you want more clarity. Okay, thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Leavitt Brothers. We're a boutique research firm that's been in business since 2002. We provide market analysis and trading ideas to institutional and individual traders. Again, thanks for listening, and I'll see you next time.